Well, it was a quieter week for the financial markets last week, with a lack of major data and news flow to impact price action, allowing equities to take the path of least resistance to the upside, with the S&P 500 gaining for a third week in a row, while treasuries and the G10FX market largely trod water, with conviction somewhat lacking ahead of the latest US CPI figures due on Wednesday afternoon. There's plenty else on the docket due beside that this week, including the latest PPI and retail sales figures from the US as well, plus another busy slate of central bank speakers in the mix too, including Fed Chair Powell on Tuesday afternoon. There's plenty for myself and Ryan Littlestone to discuss on the trade-off this week. So without further ado, let's roll the titles and get into the show. So it was a bit of a quieter week for the financial markets last week, but I'm sure things are going to liven up pretty quickly as we move towards that all-important US CPI print on Wednesday afternoon. Joining me to look ahead to that and digest everything else that's going on at the moment is my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, very good afternoon to you. I would usually start with a little bit of banter around West Ham's fortunes at this point in the show, but given that I need you to do the biggest of big favours next weekend, I'm going to be nice and go and look for my claret and blue shirt, I think.
Yeah, good luck with that, mate. As I said the other week, if you're relying on us to win the league, you've got absolutely no hope, mate.
Well, the other worry is we're relying on not just you, but we're also relying on Spurs as well. I'm not sure which is more worrying out of those two.
Well, the good news is if you're a betting man, you can get about 600 to 1 on Spurs, us and Everton winning. So you might want to drown your sorrows by taking a little hedge bet there.
Well, I was going to say, before you get there, better odds than most of my plays of the day, but we'll leave that one there, shall we?
Yes, perhaps we should move on very quickly.
I think we definitely should. Let's move on to topical thunder and those CPI numbers coming up later on in the week. So that is where we will start our rundown of all the major macro topics at the moment. We've got a busy data docket due on the whole this week, which Ryan is going to helpfully guide us through in a few minutes' time. But it is going to be all eyes on the US CPI numbers on Wednesday afternoon in terms of the data highlight. I think it's perhaps worth mentioning before we get into that data, though, that unusually it's not a unique thing, but it's relatively rare that the CPI data comes after the PPI data for April, which is due on Tuesday afternoon. So perhaps we may get a little bit of a lead from that. That may help the market position into the more widely watched consumer price index figures that we get just after lunch here in London on Wednesday. In terms of our expectations for that number, we see headline CPI is expected to rise 3.4% on a year-on-year basis, marginally slower than the 3.5% that we saw in the month of March. On the core metric, of course, excluding fuel and energy prices, food and energy prices, forgive me, that is expected to rise 3.6% compared to 3.8% previously. And when you look at the month-on-month figures, headline expected unchanged at 0.4%, while core is seen rising about 0.3%, down from 0.4% previously. So a lot of numbers are there, but the overall takeaway is we are expecting disinflationary progress to continue on the core metric and to resume when we look at headline inflation. Although it is worth noting that we have, of course, had 3 straight hotter than expected annual headline CPI prints coming into this report. So the market may be somewhat biased for another hotter number. Although I would argue that the balance of risks this time around is actually a little bit more evenly balanced. You still have a bit of an upside risk in the mix, given the rise that we've seen in energy and primarily gasoline prices. But I think on the month, food inflation should be relatively soft. And you also had a pretty sizable fall in used car prices as well, which may also add to the disinflationary impulse that we're expecting to see come through in the data. But I think whatever the number comes in at, I think there's 2 very important things to remember from a monetary policy standpoint. The first is that actually the Fed, they watch CPI, but they don't particularly care about it. And they judge progress towards their inflation mandate based on the PCE metrics that, of course, we don't get for another fortnight or so. And the second is that the Fed have effectively ruled out another rate hike in any case. Chair Powell at the May FOMC press conference saying it's unlikely the next move is going to be a hike, and pretty clearly outlining the reaction function that if inflation remains hot, if price pressures remain elevated, they just leave rates where they are for a little bit longer than they otherwise would. So personally, coming into the CPI figures, and keen to get your view on this, Ryan, as this may be a sort of famous last words situation going on here, but I think there's a relatively high bar for a significant further hawkish repricing. We've got around just shy of 40 basis points worth of cuts priced into the OAS curve by year end. And as a result of that, I think if we were to get any sort of hawkish reaction, knee-jerk move lower in equities, knee-jerk move higher in the dollar, then that's perhaps one that I would be looking to fade as the afternoon goes on Wednesday.
Yeah, I think if you're talking about where the market's going to do most of the work or be relatively volatile, is taking the CPI at pivot levels. 3% is probably the pivot level for the market getting more dovish. If we get below 3%, up towards 4%, that's going to be the line for the hawks, I think. Yeah, you say the disinflationary process is to continue. We've been pointing out on the show for a few months now. Inflation hasn't moved since June last year. It came down off the highs, hit 3.23%. I think is the lowest it's got since we came off. It hasn't been below since. So it's still sticky. So even if we get the numbers confirming a pip loss on the core and a pip loss on the headline, 2 on the core, it's still well above 3%. And that's something that Powell actually mentioned. So as much as they are focusing perhaps on PCE. He mentioned it himself at the last FOMC that inflation has been sticky for 10 months. So I think really we need to see a big variation. If we see something maybe at 3%, then the market's going to start ramping up, cut expectations. But otherwise, it's certainly a number as expected is going to rule out a cut in June and probably for the foreseeable future. So yeah, I think it's still going to be very, very sticky here. And but if it goes up again, if it does surprise to the upside and maybe creeps up towards that 4% mark in the headline, then yeah, I expect the market to come back with a bit of hawkish repricing.
Indeed, you're getting dangerously close to Dick Matthews territory there. You stop yourself just in time before you uttered those mortal words, "They'll hike again." I'm not sure. I'm sure Dick watches the show. Are you still calling for another hike, Dick, or have you given up on that one by now? Anyway,
I don't think he's given up, and I'm actually closer to his side than I am the Fed side, definitely, because as we've been saying, the evidence speaks for itself. This inflation isn't coming down. Yeah, it's creeping down on the PCE, but 10 months, this will be 11 months now of CPI being sticky. That's not going the way the Fed want it to go.
No, agreed. Although I must admit I'm a lot closer to what the Fed are projecting rather than what you or Mr. Matthews are projecting. I reckon we'll probably get 50 basis points of cuts this year, which I admit is a lot more hawkish than my original call. I was saying they were going to go in June. I think they'll probably wait until September at this point, and then maybe September and December are when they pull the trigger on cuts. But that is a story for the autumn. In the here and now, we've got, as we mentioned, another busy data calendar due this week, haven't we, Ryan?
Yeah, very much so. We've obviously talked about one of the main events, CPI, this week, but I wanted to pick out some of the other key data points and events that we need to keep an eye on. So Tuesday afternoon, we obviously get that PPI data. Then following that, we get Powell in a moderated discussion with Klaus Knot of the Netherlands at the AGM of the Foreign Bankers Association. So don't know the exact subject matter.
Event that sounds.
I made that sound interesting. I nearly nodded off while saying it. Yeah, so this is going to be his first appearance since the last FOMC, and it might be an important event just to see if he's happy with the market response since that FOMC that we got. And given that yields and the dollar have come off since then, that would suggest that he's probably going to be happy that the market is leaning his way rather than getting back to being a bit more hawkish again. But it's still going to remain an important event anyway, in case he wants to steer the market a certain way. Inflation obviously remains important for other central banks, none more so than the Riksbank, and they're touted 2 more cuts to come in the second half of the year. So CPI data for them on Wednesday could be a mover for the Swedish krona and those rate expectations. On Wednesday as well, we get US business inventories. Now, it's not a data point that's made the headlines for, perhaps the last 18, 19 months, but now the market is seemingly looking for any cracks in US data, like it did for last week's jobless claims. It might creep up the importance list. And the reason why inventories are a good indicator of activity is it shows what the economy is doing. So strong inventories suggest that firms have good sales or are confident of getting good sales, whereas weaker inventories can suggest that sales are slowing, and that's something that can affect the whole chain from the selling end all the way down to the producing end. Retail inventories fell 0.1% in a flash reading a couple of weeks ago, and that had a deeply negative run over the October-November period, which then showed up in the weak retail sales through November, December, January. So that's why these inventories can be quite important. Thursday, we have Japanese GDP, which could have yen traders having to adjust hike expectations for the Bank of Japan. And in the US, we have housing starts and permits, so the run of housing data kicking off. We get to see whether that's going to follow up last month's downside miss with another one, or if it's going to be another bounce. And on Friday, we have China releasing industrial production and retail sales. And, with further cuts expected this quarter from those guys, this data may be a bit of a decider for that. This past weekend, we've seen CPI rising a couple of points to 0.3%, but PPI remained well into the negative. So they're not out the woods just yet on the inflation front. So lots coming up. Hopefully, it will keep Michael awake throughout the week.
Indeed, yeah. I'm not sure Chair Powell's remarks on Tuesday afternoon are going to keep you awake. I'm already dropping off here just thinking about them. Quite a lot to digest there. I mean, obviously, the Chinese numbers are just nonsense because they're made up, not really worth the paper that they're written on. We've also got jobs data out of Australia. I think that could be quite a key one for the RBA. That's due on Thursday morning. Obviously, the RBA in some quarters, we're expecting them to be a little bit more hawkish than they were last week. I know Rabobank, for example, is still, despite that, sticking with their call for another 50 basis points worth of hikes. Yes, hikes, not cuts, before the end of this year. But we will see, obviously, how the labour market is evolving down under and what impact that may have. I think the business inventories data in the US is an important one to watch. I'm glad you've brought that up, not only because of the sort of leading indicator or the leading nature of the indicator, but also the big fall in inventories was actually one of the reasons why Q1 GDP was so soft compared to market expectations. So obviously key to see whether or not that is continuing. The jobless claims figures are going to be a little bit more closely watched than usual. We saw that rise to 231,000 last week, the highest since August. There's such a noisy data series that will probably be back in the low 200,000s this week anyway, but I think they are going to be pretty closely watched. I guess Powell will steal some of the attention, but my expectations for anything different than what we heard at the last FOMC press conference are relatively low, particularly when you contextualize it. He's speaking a day before the CPI print. I don't think he's going to want to rock the boat particularly much with that one.
No, I don't think really he's got any need to. If we'd have seen some excessive moves after the FOMC, then, as I say, maybe he'd look to steer it. But you never know. He might want to push the message a bit further and give us a little snippet to jump on. So you can never say never with these guys.
Indeed, only time will tell. And of course, the market is still priced, 35 basis points more hawkishly than the dots. But then if you assume the median goes to 2 cuts in June in, 6 weeks' time, then we're actually talking only 10 bips above that. So, probably not too much concern from Powell, although some of the moves that we're seeing in the market, in pre-market this morning, it looks like we're back in 2021 with the meme stock thing going on again. GameStop are up about 40% pre-market when I last looked. So I wonder whether that is causing a few nerves around how loose financial conditions may be. In any case, let's move on back here in Blighty, because it was an interesting week here in the UK last week. The Bank of England were a little bit more dovish than we expected last week. They did, of course, keep bank rates unchanged at 5.25%, but they left the door absolutely wide open to a rate cut in June. And I think there were 3 key things that the MPC did last week that really pushed that door open to cutting next month. The first was the vote split itself. It was 7-2 compared to the 8-1 that we saw in March, with Deputy Governor Dave Ramsden also voting in favour of an immediate 25 basis point cut, along with external MPC member and Uberdove Dingra. I think this is a little bit more significant than a sort of standard run-of-the-mill dissent for a few reasons. One is that Ramsden is perhaps known typically as being one of the more hawkish-leaning members on the MPC, so for him to be voting for a cut is quite a statement. And the second is that the internal members on the committee, so the deputy governors, the chief economist and the governor himself, they tend to vote as a block, whereas if one of those is peeling away and going off piste a little bit, that is perhaps the BOE trying to send a policy signal that they are indeed going to deliver a cut at their next meeting. And in fact, if you look back through pivots, both in terms of hawkish pivots when the BOE moved to hiking rates, or dovish pivots when the BOE moved to cutting rates, the playbook has been an internal member votes for that move the meeting before it actually happens. So whether or not history will repeat, only time will tell, of course. We then heard from Governor Bailey at the press conference. He again said pretty explicitly that it's likely that rates are going to need to be cut in the coming quarters. Then I thought it was also interesting that he said a bank rate may fall more sharply than the market currently prices in. So trying to push a little bit more dovishly against the market curve, which when he was speaking priced just 55 basis points of cuts by the end of this year. Must give a little bit of a shout out here to Adam Linton over at News Squawk, who picks up a comment that Bailey made back in 2021, I think it was, when he said, my job isn't to lean against the market curve. It's not to try and guide market expectations. Well, I mean, that's literally what you're now doing, mate. But never mind. When has a central banker ever stuck to their own promises? And I think the last thing that really pushed the door open to a June cut is the statement. They added a line in there, and I'll quote it verbatim, and it says, the MPC will consider forthcoming data releases and how these inform the assessment that risks for inflation persistence are receding. There's a couple of things to take away from that. The first is that, well, they believe that inflation, the risk of inflation becoming embedded is decreasing and is substantially lower than they had expected. And the other read is that data is now key for whether they cut in June. And there are two inflation reports and there are two labour market reports due before the June MPC meeting. And I think that means, for me, the outlook's pretty clear. If inflation continues to behave and falls in line with their expectations, then they're going to deliver a rate cut in June and probably at a quarterly pace after that. Whereas if inflation surprises to the upside of the MPC's forecasts, that cut will probably wait until August. But I would certainly be saying, and I'm even more confident now, that they are going to deliver that cut in June. We've got the latest jobs data due this week, which will drop just before this show airs. Of course, the usual caveats apply around the unreliability of the unemployment rate, but another fall in average weekly earnings is expected. But Ryan, I guess the question is, I think when we spoke about the BOE last week, you said they might even wait beyond August. Would you like to revise that call, perhaps?
Nope, not at all. No, there's several things.
Shall we?
Yeah, no, several points of contention I'm going to take with your view here. Firstly,
here we go.
Bailey said all that, but in the statement itself from the Bank of England, it was pretty much along the same lines as the one prior to that. There wasn't a closer mention, or that they gained greater confidence that inflation was on its way. So here we have again the head of the central bank speaking in the press are different to what the actual statement says. Yeah, they chucked that new line in. That line is just a hodgepodge of, yeah, we're data dependent. And if it goes our way, we'll do it. If it doesn't, we won't. So that's no change to anything else. The other side is, okay, so we're to take Bailey's word for it and the Bank of England's word for it, because they were so right with inflation previously when it was going up. So to say they're going to be right now, well, when it comes to the Bank of England, I'm usually happy to take the other side of that trade. And yes, let's look at it in black and white. If they get the inflation data they want, they're going to cut because they desperately want to cut. Whether it's the right thing to do, they're going to do it anyway because that's what they want to do, and no one should be able to fight that. But if the data doesn't go their way and they get caught out again, then they're going to look a bit silly. Ramsden, he had to vote that way, and we said it last week after his comments prior to this MPC. He went really into the dovish camp, so it would have been a bit of a shock if he hadn't voted that way. So the 7-2 was sort of as much expected as the possible 8-1. But yeah, I still say August, unless the data does go their way. If we get inflation 2% or under by the June meeting, then yeah, maybe they're going to cut. But if it's not, then no, August is still my, at the very least, the date they're going to cut.
Well, we shall revisit that one. I think the 20th of June is the next MPC. So, I'll clear my diary for lunch on the Friday, shall I? So you can take me out. Right. In any case, we're not just wagering lunch on these sort of things. We are trading the markets in front of us. I know you want to discuss how rate expectations have evolved and how you can trade around that as well.
Yeah, exactly. I wanted to do sort of a bit of a follow-up to last week. I spoke about not listening to the market or media hype when trading. And I wanted to talk about a similar situation regarding price moves that we see. Because I've seen a lot of surprise from people for events like central banks or big data points that haven't produced sort of massive pip moves. Let's take the Fed, for example. It seems like some traders think that one or two bad data points means that while that might push the Fed closer to cuts, it must mean the dollar needs to fall 500 pips. Then they get a bit confused because maybe on one data point miss, like we saw with the claims, we only got a 50 pip move instead of a 150 pip move that they expected. If we take an example, let's take this rate cut situation. There's two things you have to know about the Fed regarding this cycle that we're supposed to be entering. Firstly, it's likely only to be half the size of the original hike cycle because we're just not going to cut all the way back down to zero. Secondly, the market has already largely traded it. It knows that the Fed and nearly all central banks want to cut rates. All we're doing this phase is trading around the calendar when they may start and how much they may need to cut by. So when you're trading this, traders need to have appropriate price expectations for trading events like this data, like the Fed, like Powell. You need to know whether the market is expecting the data to be good or bad, and by how much it needs to miss or beat to bring a strong reaction in prices. So right now, the market seemingly wants to hit the dollar on any sort of bad news, so you know the path of least resistance. And that maybe counter trading positive news might be a worthwhile strategy. But unless you're trading, long term, and by that I mean 6 to 12 months ahead, you need to be flexible on which way and by how much a market may move for you. And that can be defined by, identifying well-defined ranges in any asset. So don't marry a trade. We say it quite often, don't marry a bias. We can trade between data points. We might get good PPI and then a stinky CPI, and the market will flip between them. So trade between the points, take profit off the table if it's there, if you trade one data point and make some money, but keep those expectations real.
Yes, absolutely. I think that's a really good point. Being nimble and agile is probably one of, if not the most important takeaways I would have from this cycle, really, the last kind of 2 or 3 years, the way that narratives have flipped and turned around so rapidly. And I think the point you make on the easing cycle is a good one. And actually, maybe easing is the wrong word. I think I prefer normalization at this point. Look back, and I know you've just said, unless you're trading over 12 months, I'm going to say, pull up a chart of interest rates since the 80s or since the 70s, be it the Fed, be it the BOE, whoever. Having rates at zero or very close to zero is not normal. The post-financial crisis, 2008 to a decade on from there, basically until COVID hit, having rates at zero is not normal. That was the unusual bit. It's normal to have rates set at roughly their neutral level, which is probably around somewhere between 2 and 4%, depending on what model you look at and what economy you're looking at. Forgive the horrific spread with that one. That's where we're going back to. We're not going back to zero. And I think that's a very, very important thing that I think the market started to adjust to it. If you look at where long bonds are, if you look at where equities are trading, I think the market's got that right. I just think it's important for traders to also have that right and not to expect, barring some sort of financial calamity, don't expect that when the Fed cut in September, they're going to go 400 basis points in the next 3 months. That is most definitely not the base case. It's a slow and steady process to get rates back to what has historically been a normal level.
Yeah, very much so. And also, as we keep saying, you need to look at trends. That jobless claims miss, the reaction to that was absolutely bonkers. A complete overreaction. Jobless claims have been averaging 215, 220,000 for pretty much 2-3 years now. It's been bonkers. So look for the trends, but economy's really going to have to fall off a cliff or really start booming to get the market moving and get central banks moving. Otherwise, we're just going to slide into this cut cycle. We'll come down 200 pips or whatever, and then we'll probably just go sideways for a long while. So don't be looking for 500 pip moves everywhere unless the data tells you need to do that.
Exactly that. Right, let's move on to That's the Setup. Always good when the host forgets the names of the segments on his own show, isn't it? Right, let's brush that one under the carpet very quickly and get our first chart on the screen. I want to look at volatility in the FX market to kick things off this week. It was a pretty quiet week for financial markets last week, and we've actually seen this downtrend in FX volatility and cross-asset volatility, to be honest with you, continuing over the last kind of 6 weeks or so. I think it's just worth noting one thing when you are looking at FX vol. These indices are put together by JP Morgan, which is quite helpful. The weightings are floating around out there on the internet somewhere. The yen has quite a high, heavy weighting in both of these indices. And you do see yen vols remaining somewhat elevated because the market is still a little bit jittery about the prospects of the Ministry of Finance coming back in. So these indices are arguably somewhat higher than they otherwise would be or perhaps should be. But I think if you look ahead to the summer and beyond that, you've got all central banks are going to be easing, you would imagine, in a relatively synchronized manner, both in terms of the pace of easing and the magnitude of easing. I don't think we're going to get much more than a 3-month gap between the ECB delivering their first cut and the Fed delivering their first cut. And I think as a result of that, volatility could well stay subdued, not just in the foreign exchange market, but also in the rate space and perhaps even in the equity market as well, which I know we discussed at quite some length and we dug into that a little bit more last week. But one sort of benefit or one side effect, whatever you want to call it, of low volatility in the FX space is that it could bring carry trades back into vogue, funding with a low yielding currency and going long a high yielding currency. And if you look at the current environment, that's obviously going to hurt the yen, you would imagine, may hurt the Swiss franc as well, with the SNB easing pretty rapidly. And then you also look at what could benefit. Well, the highest yielders in the G10 space at the moment are the Kiwi dollar, the pound, and the US dollar. But you may also argue that the Aussie dollar could be a beneficiary of that as well, particularly if the RBA are one of the last G10 central banks to cut. So although vol may remain relatively low, there are likely to be some carry opportunities out there. And I think we're going to get onto that in the next segment in a second as well, aren't we?
Yeah, definitely. And, the volatility that plays into the price segment as well, with expecting for price moves. If you've got low vol, that's another reason why you're not going to get huge price moves. But then conversely, if you do get a big data surprise, that just injects a bit of volatility at that moment, and you do get maybe an outsized reaction. But vols is something we've talked about previously. The yen is still elevated. I look at the 1 month at the money vols for FX and dollar yen right now. It's 8.84. It had been up at the 10s and 11s when we were in that intervention period a couple of weeks ago. Euro dollar, it's drifting back towards, it's under 6% now, and that's getting into low vol territory. But then that's helpful for the range plays, which is one we'll talk about shortly.
Absolutely, yes. Right, why don't we have a look at dollar MEX?
Yep. Dollar MEX, talking about the carry trade, this one is still very much valid, and it's a good follow-up to your vol story as well, and carry trades, as it remains one of the biggest carry trades around. And despite Banxico entering their cut cycle as well, it's still very valid. Now, last week's Mexican monetary policy announcement showed that they were going to take a slow and steady approach to sort of shepherding the bank rate lower as the data necessitates. And that told carry traders that there's no need to rush out of shorts. And in fact, it could be quite a long time before the rate divergence narrows to a point that's going to make this one less attractive than others, for example, in yen. Now, on the tech front, we're down at a big level at the moment, which may act as a bit of a decider for whether some of those shorter term carry traders really want to hold or fold, and that's in the 1665-70 area. We had a test this morning, and it's held. That's been a long time support area, strong support area, and it's been the gateway also to a move down to the prior 1620s lows. Now, if that door opens again, we could see a move that at least matches those lows, or we could indeed push for more. If we do hold this 1665-70 area, then I would expect maybe some of those short-termers to start taking a bit of profit. That would likely mean a push back towards that 17, maybe above that 1705 area. So for the moment, this carry trade is still good. It may still have some legs, but it needs to break this support level.
Yes, indeed. It is an interesting one. I mean, as I've said before, Mexico is not one I follow particularly closely. So all I will add, just to sort of support what you were saying, is I believe the central bank down there did actually revise their inflation forecast quite notably higher last week as well. So again, just supporting the idea that that rate differential, that carry, could persist for longer than some may have feared or may have been worried about going into that meeting, which should help with some further downward pressure. But in any case, let's get back on to slightly more comfortable ground for one of us, and let's have a chat about gold. We are going to stick with this idea of relatively low volatility because gold is frankly going nowhere particularly quickly, and it hasn't done for probably 4 or 5 weeks now, if not a little bit longer. We had that relentless run higher that still no one is particularly sure what was driving it in the middle of March and through most of April. And then we've just settled into a range, 2,300 to just north of $2,400 an ounce. And that has held pretty firm for the last 4 or 5 weeks. There doesn't really seem to be particularly much sign of the market wanting to break out of either side of that range just now, although I think it's worth noting that gold is still quite significantly detached from the typical drivers of the yellow metal, yields, the dollar and risk. So you can use the S&P 500 as a proxy for that, of course. Now, naturally, the inflation figures, CPI on Wednesday, is the big risk for the market this week, but I think actually gold quite an easy one to risk manage at the moment. If you see a move back towards those highs or even a break of those highs, the longs will be looking to get back into the market with a stop around those prior highs. And on the flip side of that, if you see the price move lower and break that $2,300 an ounce level on a closing basis, then you'd be looking to target the 50-day moving average below that. So this is one that I will happily stay on the sidelines of until either of those breaks occur. But I think it's one of those where bide your time, wait for the market to sort of guide you in what move is most likely to pan out, particularly because it does seem detached from those typical fundamental drivers that you would expect.
Yeah, very much so. And this one, you could probably overlay the S&P chart, and it's looking a very similar picture. We had a really strong rally, then a bit of a top form, had a little dip, then we're on the rally again. But I think your levels are spot on. 2,400 and use those prior spike highs, which did come around sort of Iran and Israel headlines. So they were sort of a bit outlier moves, but 2,400 remains the level there. And as you say, if it closed below 2,300, you've got a couple of levels below that as well, 2360s, 2320s, 2260s, 2220s. So yeah, keep an eye on the levels. It's ranging at the moment, and you could go with a break. But as we know, this one isn't an inflation hedge anymore. It's Nvidia, as they said this morning, Michael. And I wanted to get your thoughts on that one as well.
This is a family-friendly show, and Kyriakos already has quite a lot of editing to do at the end of this. And the last thing I want to do is create more work for him in having to edit out the number of expletives that would be uttered if I were to go into a diatribe as to why Nvidia and Apple are not an inflation hedge. I'm actually quite irate that Bloomberg would even publish that nonsense in their pages. I think it's absolutely ridiculous. And we will leave it at that. You will not get a bite out of me today, Mr. Littlestone. So why don't we get on to Euro CAD instead? There's good fishing in Canada.
Yeah, I had to drop it in there somewhere along the line. I told you I was going to, and there it was. But yeah, I'm going to look
at least you're a man of your word, mate.
Exactly. And we're speaking about range plays, and EuroCAD could be a good range play candidate. This is again another nod to your volatility segment, and a great example of finding an asset that fits a certain trading narrative. This pair is almost euro sterling like in its lack of volatility. But while I go back to those 1 month at the money vols, euro sterling trades around 3.7%. This one's a bit higher at 4.6%, so it does move around a bit more. We've got a pretty solid historical range between 144 and 148. And there's even a bit of a smaller range inside that, 145.50, 148. And we have one of those amazing magnet levels at 146.46, which can be viewed as a pretty strong pivot level. Now, trading these sort of pairs does require a bit of patience, but the tech really speaks for itself. That's not to say you can blindly set up orders at either side of the range and leave it to its own devices. But there's nothing wrong with setting some price alerts, maybe 20 pips away from the range edges, then assessing the move and why the price is moving to the edges before trading it. Because if you find a pair or asset that has low volatility and can also sort of ignore 90% of any intraday fundamental news and noise, that can be a good pair to trade just to keep your account ticking over. I mean, that's one of the reasons why I like trading euro sterling, but I also wanted to show that there are other pairs that you can achieve the same outcomes, and also that one doesn't have to be glued to the dollar for every trade you want to take. So when you get a pair like this, it can, be good for the account just to sit on the edge of the ranges and keep trading it.
Yes, indeed. Good stuff. And I think actually in some ways it's similar to the gold chart that we were just looking at. You have the top and the bottom of the range that are pretty well defined. Wait for the market to get there. Wait for the breakout to happen if it is going to happen. Wait for that to happen on a closing basis. Set the alerts up for that, of course. And then trade it even when it does happen. Let the market come to you and then react. And it goes back to what we were saying earlier about being nimble and being agile. And even if volatility is relatively low, you can just play it within that range without even having to wait for the breakout or perhaps the fake breakout, depending on how the price action occurs. But it's interesting. The common theme is, all these low vol pairs seem to involve the euro, the horrible pig of a currency that it is.
Yeah, no, that's very true. And I looked at a couple of others like Euro, Aussie, and that's pretty much the same. So there are similar themes, but as I say, it helps you get away from the dollar. So the dollar isn't the be all and end all. And what I would say for this pair in particular compared to gold is that the gold range we're in is very short term. We haven't had this historical price action up here. Whereas EuroCAD, you can see that zone 144, 148 goes all the way back into 2019 and beyond. So you've got that history to lean against as well to back up your conviction for playing the range.
Yes, absolutely. That is a great point. Right, let's get on to our plays of the day. Okay, so two FX plays of the day for you this week. I'm going to get things going with cable, relatively short and sweet here. I am thinking cable is going to move lower, so I'm going to be short cable this week. If you look at the money markets here in the UK, the OAS curve still sees, and we're recording this Monday afternoon, by the way, so this may change depending on where the jobs data lands Tuesday morning. But at the time of recording, the market pricing just a 55% chance still that the BOE do indeed cut rates in June. And I think that's pretty underdone given my view on the BOE that we outlined earlier on and the fact that inflation is likely to get back to 2% in both April and May when that data is released. So I'm going to go short cable as a play on that, on an expectation that the dovish repricing we should see of that OAS curve as the market becomes a little bit more confident that we are indeed going to see the BOE start their easing cycle in June if that data continues to come in line with expectations. And also sterling or cable rejected the 200-day moving average at 125.45 on Friday. So happy to go short at market with a stop just above that level. And of course, we have that interim low that we've tested a couple of times recently at 124.5, which I will be using as an initial target. And I think me talking about the BOE has brought the ghost of Mr. Matthews back into this room.
There we go.
Lights. So I'm not sure what's going on there. Let's move on quickly before he haunts anything else.
He's at it again, the old telepathic Dickie Matthews. He heard you talking. See, you tempted his fate again. But yeah, I'm gonna stick it. Stay away from. Don't electrocute yourself, mate. I don't want to be doing this show on my own next week. And but I'm gonna talk about. I'm gonna try and talk about Aussie Kiwi while you flicker in and out of light.
I'm back.
He's back. Well done. I'll make this quick then. I'm looking at a simple low risk trade this week. We've got a bit of a level up here in Aussie Kiwi around the 110.20 area. And I'm eyeing it for a potential break long because the price action looks fairly bullish, and we have the RBNZ perhaps a bit closer to rate cuts than the RBA. Now, it's not as clean a level as I'd like. I really like a well-defined level. We've had a few little wobbles up and above it. So I'm undecided how I actually really want to play it. One option is to run a clean buy stop entry through somewhere like 110.25.30. The other option is to wait for a break and then look to buy a confirmation dip, a test back to sort of the 20 level. And if that shows up as support as holds, then I'll initiate a long. But I also can't rule out the fact that a short might still be a valid play up here into the level if it does hold on another test. But then again, maybe with a stop reverse if it then breaks higher. And that's a good thing about trading. You don't need to be tied to one side or the other, long or short, when you're purely looking at technical trades like this one. So, there's three potential options to have a trade off of this level.
Indeed. Good stuff. Right, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing things together as brilliantly as always. Hopefully you've enjoyed the show. If you have, drop a like on the video. Leave a comment as well. Let us know how you're trading the markets and your thoughts on everything that we've brought up this week. And also, if there's anything you'd like us to discuss in next week's show. And that is indeed when we'll be back with another episode of The Trade-Off. This time next Monday, I will either be overjoyed after Arsenal have won the league or crying into the camera after we've given it up and West Ham may not have done us a favour. So we will see what emotional state I'm in this time next week. In the meantime, have a very good week ahead and we'll see you next week. Thanks for watching. Goodbye for now.